So welcome
Okay.
everyone as you're coming in. Thank you for being here. My name is Roz Cutler and I'm an adult programming staff person at Redwood City Public Library. Thanks so much for coming today. I'm talking as you're coming in. And I'm going to wait to introduce Darian until you're finished arriving. But thank you so much for being here today. Great. I think I can begin. Again, my name is Roz Cutler, and I'm an adult services and programming librarian at Redwood City Public Library. And I'm here to just welcome you today and also just talk about a couple resources on this topic that you can find at the Redwood City Public Library website. If after today you want to have some more questions about financial planning and want to do some more research, you can go to redwoodcity.org/library, or just Google Redwood City Public Library, and you'll find on the Get It Online page, there's a box that says business. And you can look at the two resources there. One of them is called Business Source Complete, and it has information like articles on taxes, articles on annuities, articles on insurance, and it has information for consumers on, what kind of insurance should I buy? If I want an annuity, is it a good idea for me? So it's exactly the kind of resource that's going to be really helpful for you after listening to this short talk. And then also there's another one called Data Axle, and it will help you find information on companies and also information on like personal and professional directories. So if you want to know more about a company, or if you want to know more about a professional in detail, it's super helpful for that. So those are just some resources that you can find at the library that'll help you on this topic. And then I'm really mostly here to welcome Darian. We work together on doing financial planning programs at the library through a wonderful organization called Financial Planning Association. It's the Silicon Valley branch of the Financial Planning Association. And usually we have in October every year, September, October, November, whenever Financial Planning Week happens, we do Financial Planning Day and you get free financial planning advice. And then prior to that, we do an online seminar. And we're going to invite you to participate in that this year. So that's a great opportunity to be with us and get some more financial planning advice. So we'll let you know about that. Darian has his own company and he does financial wealth advising and has he's a certified financial planning, and he has another certification, CRPC. I'm not even sure what that stands for, but he's a very well certified, and he can really make you understand things about financial planning beyond what most people can, because every time he does a talk, I learn more. So he's going to take it away and help us understand some more today. So thanks again for being here. And I'm going to stop my video so you can see more of his screen. Thanks a lot.
Thanks, Roz. Happy New Year, everyone. I hope everyone had a nice holiday break. And if you're like me, right around now, you're starting to feel like the year has gotten started. So the hope is that you're here today to learn a few things. We wanted to touch on primarily two topics. There's going to be a couple of subsets that we cover today, but since we are starting the year, many of us start to think about tax filing. So we thought we'd spend some time talking with you about that. And then as a subset of that, the way I always tend to think about it is just about every financial decision we make has a taxable ramification. And a lot of times, many of those decisions hover in the neighborhood of investments. So we're going to touch a little bit on some, call it tips to start the year, things to keep in mind relative to your investments. And then I also think, just based on my understanding of the group that I'm talking to today, there's a deadline, a slide that I'm going to share with you a little bit later, talking about key deadlines depending on your age. As we enter a new year, there's a number of things that we tend to want to keep in mind depending on how old we're getting. So I'm going to walk you through a lot of that. But the goal for today, just similar to a lot of our educational events, is to try and cover a broad set of topics. So that way, those of you that are here, hopefully get one or two things out of the discussion today. I always set a goal for everybody on the call. Like I said, one or two things that you can take action on in the next 24 to 48 hours. Got to be pretty soon. And the reason why I always emphasize this is because there's lots of studies done on information retention of the human brain. And sadly, it's not great. So it's important. That's why I set the number low, just one or two things that are going to stand out to you with what we cover today. And then the hope is that, again, today, tomorrow, we do something about it, whether it means making an appointment with somebody that we need to make or looking into something that we've been trying to do. But that's my encouragement for you today, is to try and just pick one or two things that you can grab for today, do something about it fairly soon. And the hope is that starts good momentum as we start the year. But the place where I wanted to start with you is on taxes, because as many of us on the call are probably familiar with, every year that comes around, there are new rules, there are changes to things, and there's a number of things that we have to start paying attention to when it comes to that. So a couple of things. Hopefully I've made this big enough to where everybody can see it. So I'll make it a little bit bigger. Hopefully that looks okay. So a couple of things to emphasize as we turn the calendar year here. Just like every year, marginal tax rates that determine what taxes we pay on our income, they always tend to creep up year over year. So a couple of things to be aware of. If you take a look at how things are currently situated, one of the things that you'll notice right away is that tax rates climb up proportionally speaking. So whether we're married or whether we're single, those numbers are proportional to one another. But I highlighted a couple of areas because there's a few planning tips, as I like to think of it, that for you to be aware of as we think about this. The first is I highlighted the 12% marginal rate for married and single individuals. The reason why I highlight that is because there's an important distinction at that level. Those of us who are familiar with capital gains and how those work, your typical capital gains rate on a federal level, you have to pay 15% if we sell a security for a gain, assuming we've owned it for over a year. But what you'll notice is that marginal tax rate is below that 15% capital gains rate. So a typical rule that we remind everyone is your capital gains rate is typically not going to be higher than your income tax rate. So if we're in this lower income tax rate, where for married individuals, 94,000 and change, and then for single individuals, about 47,000 and change, if our income is below that, there's an interesting opportunity that comes up here, which is at those income levels, if we generate some additional capital gains, we don't pay any taxes on those gains up into this limit. So it's an important thing for us to keep in mind. If we have a relatively low income year, maybe we just retired, or maybe we're pulling back on work, or maybe certain incomes we had been receiving have stopped. If this is a low income tax year for us and we have appreciated securities, it's worth thinking about considering selling those if we've been wanting to do that, and then we pay a lower rate as a result. At the same time, the other thing for us to be aware of is up on the middle portion of the screen here, your standard deduction is going to play a big role for most of us. As of the tax changes that happened in 2017, a lot of the typical deductions that we took prior to that were essentially covered up by this higher standard deduction. And the way that standard deduction works is you take whatever income you've earned for the previous year in 2023, and you deduct, if we're married filing jointly, we deduct 29,200 from that income, or if we're single, we deduct 14,600 from that income. And that lowers our effective liability that we're going to have to pay relative to taxes. So those numbers are important for us to realize, because every year those numbers creep up a little bit, but for most of us, we fall into that category of just taking the standard deduction as opposed to itemizing on something called a Schedule A. So keep those in mind, depending on what we expect our income to be for not just for 2023, but also the numbers I'm showing you for 24. There's some planning opportunities that'll exist here. Another thing for us to keep in mind is if our incomes are relatively low for this year, this may be the opportunity to take income if we have the choice to do it. So if we're in a consulting kind of a job, then maybe there's income we can bill for this year. Again, if we plan on generating any capital gains or investment income, this might be the year to do it. So keep that in mind as you start to plan for this year. A couple of other things that are important for us to be aware of, and we'll jump around on the page a little bit, but right here at the top, you'll notice that IRA and pension limits is the other thing that I highlighted. The increase in contributions this year went up by about $500. So last year, your IRA contribution was $6,500. This year, it's $7,000. And then as a catch up, we can add an additional $1,000 if we're over the age of 50. So keep that in mind if we're regularly contributing to our IRAs, get a little bit more in for this year. And at the same time, if we're still working as an employee of a company and we get access to a 401k, that limit has also climbed up a little bit this year as well. So total contributions, if we're over 50, gets to be 30,500. If we're under the age of 50, 23,000 even is what we get to contribute for this year. On the left side here, pointing out a couple of things. If we have a high income for last year or for this year, it's important to realize that if we do generate capital gains, like I mentioned, the 15% capital gains rate is the standard rate that most of us will pay. However, similar to the idea that if we have an income below that 12% marginal rate that I was showing you earlier, you pay 0% on that. Unfortunately, if we make more, if we're joint filers, if we make more than $583,000 as joint filers or more than $518,000 as a single filer, we're actually going to pay a 5% premium tax essentially on that capital gain. So again, something to be aware of when it comes to planning. And the other area that I think is important to realize is here on the right side of the screen, is if our income exceeds 200,000 as a single individual or 250 as a married individual, we also have to pay some additional taxes that comes in with this. The one political comment I'll make on this is we're probably all pretty aware that as a budget, as a country, we're unfortunately spending a lot more than we bring in as income as a country. So as a result, you're seeing some of these additional taxes being applied to higher income levels to try and offset that a little bit. But the reality that we'll all have to deal with is as you earn more, there's a little bit more that goes into taxes. But the way that we always tend to look at this is the rules are what they are, but what we want to make sure of is that we're playing them to the best of our ability. And we always think a place to start is making sure we're educating ourselves appropriately on where the opportunities are and also set expectations appropriately for where they might end up. The last two things to touch on as far as taxes are concerned, those of us who are gifting money to siblings or to other family members, that number has increased a little bit this year as well. Last year, you could gift $17,000 to any individual and no limit to the individuals you can gift to. This year, that number has risen to 18,000. So if we have a regular gifting to different family members or what have you, just realize you can gift a little bit more for this year. And similarly, the estate tax exemption has also gone up a little bit, so up to about 13,600,000. So there's at the end of 2025, these rules are going to change, right? So for next year, we'll see an inflation adjustment to these same numbers that I've covered. But then in 2026, we either revert back to the Obama era tax code or whoever's the sitting president at the time might issue a new tax code. We'll see what happens. But keep in the back of our minds for our longer term planners that there's likely to be some sort of change to the tax code in a year, in two tax years from now. The one last thing I wanted to touch on, because many of us on the call might be receiving Social Security at the moment. You got a cost of living adjustment of 3.2% from the last year. If inflation continues to fall like it has been, this year's cost of living adjustment will probably be a lot less. It'll probably be in the 1% to 2% range as opposed to the 3.2 that you saw from the previous year. But the last thing I wanted to highlight is something that oftentimes gets overlooked, but it's a very important concept, which is depending on the income that we earn outside of Social Security, it'll determine the level of rate that we have to pay in taxes on our Social Security income. So you see these two levels here. There's a 50% taxable level and an 85% taxable level. So in other words, what that means is you take your Social Security that you're receiving, and if your income as a joint filer, if it exceeds 32,000, then it means that 50% of the benefits can be taxable. If our joint income exceeds 44, then 85% of the benefit becomes taxable. Numbers adjust slightly downward for a single individual, right? 25,000 in income means 50% taxable, and 34,000 means 85% taxable. Now, for many of us, especially if we're living here in the Bay Area, that's going to mean that those numbers are relatively low. So we have to be prepared for some taxable nature to show up as far as Social Security goes. But if there are some of us on the call who are primarily calling Social Security the main income source, then your overall income is relatively low. And this is an important thing to think about because I mentioned earlier the possibility that if your income is low, maybe we start taking capital gains, maybe we start doing a few of those things. However, if you're receiving Social Security currently and you're at this income level, the one recommendation I'm going to make is try to stay there. And the reason why I say that is because if we start to add income above this line, not only do you have to pay taxes on whatever other income you've generated, you're also going to have to pay taxes on the Social Security income. So it's sort of like this double taxation that comes into play. So if possible, if we're down at that level, try to stay there for this year because it'll save you a little bit more in taxable liability. So hopefully that makes pretty good sense. I know I've covered a lot in a very short period of time. As a discussion that I was having just before the call, I'm going to leave my contact information up towards the end here. So if you have any questions, you'll be able to get a hold of me and ask anything that you need to at that point. Relative to taxes, though, I think the important thing to keep in mind, while the tax filing deadline is around April 15th, and then there's an extension that takes us all the way out to October, I'm a big fan of getting things done early, mainly because life tends to take over, and then before we know it, we're pushing up against deadlines. So for most of us on this call, if we have any investment accounts, we're going to receive the tax forms in they're called 1099s and 5498s. We're going to start to receive those usually around mid-February or so is when those show up. As you start to collect that information, two important tips as we think about tax filing for this year. Designate a place to collect all of your information. If you're like most of us on the call, you're getting different forms, right? Maybe if we have a mortgage, we're getting a tax statement on that. For our investments, we're getting tax statements on that. If we're still working, we're getting another tax statement in the form of a W-4 on that. So, or a W-2. So
put those with my other tax forms.
I'm sorry? Oh, Bart, I don't know if you accidentally unmuted. So if you have a question, then by all means, speak up. So a couple of other things just to be aware of relative to the tax forms. So again, have a place where we're collecting it so that way it's easy to reference. Most of us, if we work with an accountant, they'll send us some sort of documentation to prepare, like a questionnaire to fill out. Most clients that we talk to take one of two approaches. They either schedule the time and literally they put it in the calendar, they schedule the time to say, here's where I'm just going to go through it all in one sitting. Some of us need to piecemeal our way through it. So a couple of things I recommend. If you are being sent this questionnaire, go through it and fill out what you know right away off the top of your head. One of the important things with projects, especially if we don't like the process of filing taxes, it's good to break that up into a couple of steps. And so the first thing is fill out what you know, right? So your basic information, the things you know off the top of your head, fill that out. A good byproduct of that exercise is by going through that questionnaire once, you start to log in your head the other things you're going to need to track down, and then it makes the job itself not so unruly or so overwhelming. So get started early on that, and then if you have to make an appointment with your accountant, I also recommend scheduling that fairly soon. Accountants are notorious for once they get into the March, especially into the April timeframe, it's very difficult to get a hold of them because they're constantly now filing taxes for everybody. So if you haven't made your appointment, set it now, and then that way you have a deadline to follow up around. If you're like me, you operate better with deadlines. So setting that for yourself so that way you have something to follow up around, I think is really important. And then if you can get in the habit of it, whether you use a filing cabinet or some sort of filing system, have each year set aside, right? So if you haven't done this before, then here's your chance to get started. You create a 2024 folder. And as you start to receive things for this year, you start to collect in one space. Makes your life so much easier instead of having to track everything down afterwards. There are now more and more storage solutions on a digital format. So if that's an easier way for you to do it, I highly encourage that as well. But whatever system is going to work, just the important thing to recognize is that we start to get these documents and all this information throughout the year, and it's spread out throughout the whole year. So it's difficult to remember where everything goes if we don't put it all in the same place. So I highly recommend creating or starting a filing system and then make sure that we're collecting that as we go along. And then the other thing to think about is if we anticipate any changes from year to year. So let's say common example that we tend to see in 2023, we have a higher level of income. And let's say this year we're planning to retire. So one of the things that we know is that our income is going to drop substantially. When that happens, that tends to open up some opportunities for planning. But we don't want to ask that question in November or December of this year. We want to start asking that question fairly soon. Maybe if we're working with an accountant, that's when we want to have that conversation, is to say, hey, I'm expecting a significant change to my tax situation. What should I be thinking about? What are my opportunities? What can I do about it in this year before I reach the end of the calendar year? So try to be proactive, try to think ahead a little bit. Admittedly, most accountants are not paid to look forward. Their job is to look in the rearview mirror because they're helping you file for 2023. But every accountant can be prompted, as I like to say it. And all you have to do is just ask the right set of questions, which is just really saying, let's pretend that we're filing for 2024, right? Let's pretend the year is over. My situation has changed accordingly. What should I expect? What should I look at? What are my opportunities? That's a pretty straightforward question that you can ask an accountant that they just have to be prompted to do it. They know how. They just won't do it unless they're asked. So ask questions, try to learn a little bit more about what's happening. Similar to the educational events that we're providing here, your best solution to your financial process, whatever you're doing now, education is always going to help when it comes to this. So, and it tends to make things a little bit easier to work with as well. The last thing that I want to mention on taxes before we shift a little bit to talk about investments, when it comes to the current tax regime, it's a complicated space. So having some resources that you can refer to, I think, is always a good rule of thumb. There's a number of websites that exist today where we can look that up, but most of us have a variety of different ways of seeking out this information. A good place is to start with your search engine, whether you use Google, whether you use DuckDuckGo, whatever you use. Start to look up a couple of basic concepts if you've been wanting to learn more about it. Usually beginning of the year is a good time to do it because we're starting to think about this and we're starting to plan for it and take the necessary steps there. So good time to check those things out or teach ourselves a little bit more about that if possible. And then you have hopefully a couple professionals you can reach out to, whether it's your accountant, if you're working with an advisor, a financial advisor now, that's perfect person to talk to. And then again, I'll leave my information at the end of the talk here today. And then if you have questions, you can reach out to me as well. So I want to switch gears and talk with you about a couple of planning and investment concepts. So I'm going to switch gears here and put up a slideshow here for us to take a look at. So, all right, so let me take this.
And Darian, while you're doing that, I just would encourage people to put questions in the chat if they have any. The chats should be accessible.
Yes, good point. Good point. All right, so hopefully we can see this. All right, so I'm gonna turn this, make this a little bit bigger, so hopefully we can see it. Oops, hold on one second. Okay, so all right, can we, Roz, hopefully this looks okay on your end?
Yep, it looks fine.
Okay, all right. So key deadlines. This is arguably one of the most important slides that we talk with our clients who are in the age range of 50 to 70. The reason why this is so important is because this 2-decade span, there are a number of important milestones, let's call it, that we're going to come across. So depending on what age we're turning this year or what age we already are, it's a quick reminder in terms of things that we want to be thinking about. For those of us who turn 50 this year, an important feature that's going to show up in your retirement plan is the ability to make what's called a catch-up contribution. Catch-up contributions are additional contributions you get to make above and beyond the typical voluntary contributions that we make to things like a 401k or 403b. For those of us who turn 55, if we've been looking to take withdrawals from our retirement plan, 55 is the first year where you'll be able to do it without paying a penalty. But there's an important distinction here. Not all retirement plans are the same. So specific to what we're covering here, we're talking about things like 401ks, 403bs. So think of the plans that start with fours. This is not including things like IRAs, which many of us on the call may have. Those have a different deadline, which is 59 and a half, which is that next one that you see here. So important distinction, depending on the retirement plan that you have, if we turn 55 and we have something like a 401k, we can start taking distributions from it without paying this early withdrawal penalty. However, if we're in anything else, we have to usually wait till 59 and a half. And at that point, we can start drawing without taking on an early withdrawal penalty. However, assuming that it's a pre-tax plan, like a traditional IRA or rollover IRA or 401k, most of the income we have to take out of there is taxed as if it's receiving a paycheck, because it's important to remember that the way we funded most of these plans is by deferring the income. So IRS always gets their taxes at the end of the day. So what that means is as we start to draw out of here, there's going to generate some ordinary income tax liability. So important to do some math, again, maybe with our accountant to figure out, hey, if I want to take out a certain amount this year, what is that going to cost me? And that'll help you just make the decision in terms of taking out more or less for this year. At the age of 62, it's the first year where we can start taking Social Security, but it's also important to remember that it essentially discounts as you're seeing here on the screen. But the way that we think about it, it's a pay cut essentially, because your full retirement age usually lands you between 66 to 67. So what that means is if we take it that early, we're going to take somewhere in the neighborhood of about a 33% pay cut on that distribution. So just be aware, it doesn't mean we don't take it. It depends on our situation. A classic scenario where we encourage clients to take it early is if there's some health issues and we're not confident that we're going to live long enough to really take the full benefit. Or if we have this gap, what we call an income gap. An income gap is the difference between the incomes we receive and the expenses that we need to live our lifestyle. If that income gap is roughly the same size, or by taking Social Security early, we can cover that income gap and it saves from us having to pull from savings, we might consider doing that, just depending on the rest of the situation. In an ideal world, we'll be able to wait to our full retirement age around 66 to 67. Before we get to that age though, at 65, any of us who are turning 65 this year, you qualify for Medicare. Now, there's two important things to keep in mind for those of us on the call turning 65. Whether you need the insurance coverage from Medicare or not, you still need to apply. And the reason for it is because there's a long-standing rule that the federal government has had in place where they want to at least make sure they know that you're turning 65 and that you'll eventually be taking Medicare benefits. So whether you need it or not, you still need to apply for that. Now, if we are planning on switching over to Medicare, unfortunately, Medicare is a really complicated program. It's just not, I wish I knew the line of thinking that people went through when they built the program. You would think they'd make it simpler, but it's unfortunately very complicated. So start early. For those of us who are turning 65 the next month or two, if we haven't done something about it, get started right away. I always recommend about a 3-4 month lead time. It gives you some time to learn and understand what you're doing, but also as you're making decisions, you're probably going to have some questions and probably need to look a few other things up. So start early and give yourself time so we're not running into the deadline there. And then as we go through, it's important to recognize that Medicare has multiple parts to the plan. So it's also understanding what your needs are, and can you just transition your current healthcare plan and pick up the same one, or you're going to have to change plans. And if we have to change plans, then we're going to have to do a lot more digging and research to understand what we're doing there. So start that process early. There are, one of the things that a lot of people don't know, there are Medicare brokers that exist in a variety of different shapes and sizes and variety of different services. Many of them do not charge you a fee to consult. What they receive is a commission once you choose your plan. So I highly encourage you to look up a resource in that way. If Medicare is something that you're not comfortable with and you'd like a little bit of assistance, there are brokers that exist to help out with this. 66 to 67. By this time, we are reaching now full retirement age, depending on our birth date. And from there, you now can consider taking Social Security where you're getting 100% of your expected benefit. So a couple important things to consider here. If we're reaching that age and we've been waiting for this time to start taking it, I'll give you the same rule as I gave you for Medicare. Start the process early. Give yourself about 3 months lead time, partly because there's forms and things that we have to fill out for Social Security. Some of us can do this online and the whole process goes a lot smoother. But some of us are going to have to go into the Social Security office. And I've gone to the Social Security office with clients a couple of times. It's a lengthy process. Sometimes you can be there for 4 or 5 hours. We've been there that long before. So just kind of depends on what's going on. But again, give yourself time, because just like any other government entity, things just tend to take longer. So it's important that you get an understanding of what you need to do, what forms we need to fill out, where our local Social Security office is, just try to understand those things and then start that process early. Worst thing that happens, you finish, you submit everything early, and you got to wait another 2 months before you receive your first check. But that to me is the best outcome. So keep that in the back of our minds. As we reach age 70, this is the latest I would recommend anybody waits before they start to claim their benefit. If you've been able to wait this long for it, good for you. Probably means you didn't need the income. And now you get a bonus to the tune of about 25% over your 100% benefit. So it's a good place for us to be if we're reaching that age. But it's important to recognize that beyond age 70, we don't build up any additional Social Security credit. So if we're planning on taking it, take it now. And again, same rule. If we're 3 months away from turning 70, start filing now. The last age that I wanted to talk with you about is 73. So this is an age that's been moving around a lot. Previously, it used to be 70 and a half, and then we had to start taking these required minimum distributions from our retirement plan. Then it got pushed to 72, and then 2 years ago got pushed to 73. To make this more complicated, over the next, I believe it's 8 years, that age is going to gradually float up to 75. So it just depends on how old we are now, and then you'll start to get a better feel for when you're going to need to take this. But RMDs are important to plan around, because if we're in a situation where we don't need to take distributions from our IRA, when you turn 73, you're going to be forced to take it, right? So some planning is going to be worth doing to try and say what happens when my income jumps up by this amount. And then for those of us who have been taking maybe smaller distributions, as we reach 73, we might have to lift that up again. So just again, some planning would be important. So for those of us working with an accountant, if we're turning 73 this year, good time to ask these questions about how does this work? What do I do? What is the impact to me? But as you can see from the slide here, there's a lot going on in this 2-decade span. And so it's important to figure out where are you, and then what's your initial next step that you need to take from here. The one other thing that I wanted to touch on before I wrap up with you here is relative to the investment side of things. So there's an important distinction that I always like to point out when it comes to investing. Some of us may be concentrated in on one type of investment. Many of us might be more diversified. One of the examples that we always like to use with everybody is the idea of your investment being a single window pane. If we have the majority of our investments concentrated in one spot, what we tend to see is if there's any bad news or anything that happens in the meantime, then the entire investment could be at risk. So this is where having a diversified approach would be helpful, because this is not the picture that we want with our portfolio. We want it to look more like this, where we have different segments of our portfolio invested in different places. So that way, if one thing breaks down, then that way we're not likely to run into a major issue. However, there's diversification in a couple of different levels, or if you imagine a couple of different dimensions. When we say diversification to people, most people think about having some stocks, having some bonds, have some investment in the US, have some investment outside. But that's just one dimension. Investing over diversifying your tax situation is also important. So we spent a lot of time talking about pre-tax 401ks and IRAs. Keep in mind things like Roth IRAs and other types of vehicles where there's different tax treatment, because if we can diversify the taxable nature of our investments, it's going to give us a little bit more control over maybe when or how much we pay in taxes when we decide to draw off of it. So it's important to diversify on that. The other one that often gets lost in the diversification discussion is diversification over time. What we mean by that is that slide I showed you before that had those different ages. That's a good example of saying, hey, there's these different events that are coming in my lifetime. Other examples of this could be grandkids entering the family, right? If we have children who are about to have kids or start a family, it's realizing that dynamics in life changes once those things tend to happen. So for all of us, we have different events that are waiting for us later on in life. And as we can think about those, if we can plan ahead, then we can be a little more nimble and a little bit more strategic in the way that we approach it. It usually ends up with better financial outcomes at the end of the day. So don't think of diversification just in terms of investment, but think of it in terms of taxes, in terms of time, in terms of a variety of other dimensions that are ultimately going to hopefully contribute to better performance and ideally lower risk and lower volatility. Couple of basic rules for us to think about. As we enter 2024, we're coming off of a 2-year period that's been a pretty wild ride. So for those of us who remember back to 2022, it's a pretty negative year for the majority of that time. We saw losses anywhere from, on the low end, it was a loss of 11, 12%. On the high end, it was a loss of 37, 38% if you were heavily invested in, let's say, technology. So that wide range of loss tends to leave an impression on people in the following year. And as is kind of the classic investment or market behavior, 2023 bounced back pretty well. And what's interesting, though, is many of us, unfortunately, tend to be prisoners of the moment. And so the line of thinking is, hey, maybe the stock market's doing pretty well. The thing that we want to remind everybody is if you take a 2-year snapshot of the stock market, so go back to the beginning of 22 and end up at the end of 23, you're basically break even. Now, doesn't mean that you shouldn't have invested over that period of time or that nothing happened. If we are invested in something that pays dividends or interest, you picked up income over that period of time. So it wasn't a total loss. But it is a good reminder that no one can predict what happens with the stock market from year to year. So what's important is having a basic framework that we're going to follow in good times and in bad. Maybe we make some adjustments to that framework depending on the environment, but we want to have some sort of baseline that we can fall back on. If you take your classic 60-40 portfolio where you have 60% stocks, 40% bonds, in 2022, you probably saw your stocks fall well below that 60% line, and then proportionally, your bonds got a little bit bigger. Hopefully, at the end of that year or some point in that time, you right-sized it back to that 60-40. So that meant buying more stocks and getting yourself back up to that 60% line, selling some of the bonds if they help to preserve value. That would have rewarded you in 2023, where take something like the S&P 500 that was up 24% last year. So now if we take a look at that same portfolio today, maybe we're looking at something where that stock portion of the portfolio is maybe 67, 68%, maybe even 70% of the portfolio, and our bonds are down in the 30% range. Here's a good time to right size that again. Having talked about taxes with you, I understand some of us on the call may say, I don't want to pay these additional taxes. There's a famous saying that we like to use in our industry is don't let the tax tail wag the dog. Taxes are a result of good decisions at the end of the day, because we only pay taxes when we make money. So hopefully this is the result of good performance is why you're paying those taxes. But coming into this year where there's a long list of things to be concerned about, this is a good time to reset the allocation and just make sure you're in the right place. Timing is virtually an impossible game to play. So we don't want to try and play that game. It's just more so along the lines of saying, what does my lifestyle need in terms of an investment allocation? Let's follow that and make sure that I stay roughly in line when it comes to it. So again, I've covered a lot of ground with you today. So for those of us who maybe wants to have a follow-up or who want to have a quick chat, let me fast forward to the last slide here and I'll leave my information up. And then if we have any questions, this is a good time for us to address that. But I appreciate everybody's time and attention here. So let me know if we have any questions that we can address.
Darren, I do have a question. Do you have do any seminars on wills and what's the other wills and
trusts? Yes.
trust? Yes, wills and trusts.
So yes, we do. That falls under the umbrella of what we call estate planning.
Okay.
So this is anything from figuring out how to organize our estate and get it more streamlined, or the more common discussion that we have with estate planning is how do I take my current estate and transfer that wealth to next generation or to the people that I want to transfer it to. Wills and trusts are kind of a basic document that we utilize to affect those wishes for the individual. There's a lot of steps and a lot of bells and whistles that can come along with it. So yeah, we can do an entire session on that. There's actually quite a bit to discuss there, but the slideshow that you saw me kind of sorting through today, we have an entire slideshow dedicated just to estate planning, so we could certainly address that.
Thank you.
Of course. Any other questions? Oh, Roz, you're muted. You got to unmute your mic.
I'm unmuted now, and what I was saying was thank you so much for giving your time today. And
My pleasure.
that was a great talk. I'm sure everyone learned something, and I was just getting my folder out and I made it last night.
Good.
With 2024, it's got one document in it with my extremely small amount of interest that I got yesterday. So, you know, how much interest I got from the federal government, which was so laughable. But the point was, get organized, and you know, step one is complete. But yeah, Darian is so right about how difficult it is to think ahead. And I even had that conversation last night with my husband about how do you have the conversation with the accountant about getting advice?
Yeah.
You know, within the limits of what an accountant can do. And I think that was great advice about, you know, pretend it's 2024 and you're filing your taxes. What should we have done, or what should we be thinking about? And there's a question in the chat. How
Okay.
do we find fiduciary tax and planning professionals? Such a great question. I mean, I now have someone great, and previous to that, I think we had the worst person we had ever had, and
Oh,
that's
sorry to hear that.
what led us to do our homework better. But what's your advice about that, Darian?
Yeah, that's a good question. There's a couple of ways to look at this. In the finance industry, there are certain firms that are set up as fiduciary firms. So Ameriprise, the firm that I'm part of, we are a fiduciary firm. So what that means is not only does the firm hold, call it liability if anything goes wrong with the client, but the advisor is also held personally responsible if anything is done that's not above board. So that's the first thing to look for, is which firms hold themselves out as fiduciaries. The other way to go is, if you're looking for an individual, is if you're having a conversation with them, you just ask, are you a fiduciary? It's a pretty simple answer. Just so that you know, for someone like myself who's a CFP, that also is another level of fiduciary responsibility, because that designation requires that from us. So in my case, I have essentially 2 layers of fiduciary responsibility, one issued by my firm, one issued by the designation that I provide. So if you work with anybody who's a CFP, they, by virtue of having that designation, they are a fiduciary. That's comes with having that designation. But it's just asking the question. If you don't know anyone, or if you're not familiar with any firms who do it, a basic internet search will find you that pretty quickly, because as a good example, if you take some of the bigger financial institutions like Goldman Sachs or Morgan Stanley, they're not a fiduciary firm, and they'll say that as well. So you can start by doing a broad search, but also if you're in conversations with somebody, you can ask about it. Most clients, if you know someone who's already working with an advisor, most clients know whether their advisor is a fiduciary or not. So you start by just asking those basic questions. But if not, then you do a basic search and you'll be able to find it pretty quickly.
Do you do taxes?
I don't. My job as it is busy enough, but the way that I run my practice is I refer to a couple of accountants that I've worked with, so that we share clients. So I'm familiar with the work that they do. We do joint meetings with the clients. So that's one direction that we go in. Relative to taxes, part of the reason that I'm able to talk about it is because I review tax returns all the time. So I've become very familiar with it. If I ever got tired of my career, I'm sure I could become an accountant, but we know how to speak the language, but I don't have the designations to file taxes. So what we would do is we would help prepare you, go through a planning process, and then recommend you to an accountant to do the actual filing.
Thank you. You were very, very informative.
Thanks. We try.
Well, thanks again for your time, everyone. And I hope you learned something. I always do. Thanks,
Thank you,
Tia.
Darian. Thank you, Rosalind.
My pleasure. Happy New Year, everyone. Take care.